We have 25 minutes, and we're going to try and avoid any sales pitches or long, extended, boring answers. If you look like you're dropping off, one of the boys will streak just to maintain your concentration levels. So can I just quickly ask, starting with Richard, the panel, to introduce themselves, company and their role.
Hi, Richard Blakesley. I'm co-founder and CEO of Capital Pilot, and we work with early stage businesses to prepare them for the fundraising process and help to introduce them to the right investors.
Hi, I'm Chris Ray from Seeders. We're an equity crowdfunding platform, raising anywhere between 50,000 and 5 million for growth-focused businesses. We've raised around 230 million across about 400 deals since 2012.
I'm Colin Goldstein from iWalker. We're an online lender and we specialise in lending to small businesses.
My name is Megan Reynolds and I'm a fundraising manager at Crowdcube. We are the world's first and the UK's leading crowdfunding platform. And we have had about 320 million invested through the platform since 2011.
That is the end of the pitching of the platforms. I hope you enjoyed that. So I did an Oxford Union debate with a bloke called Anthony Jenkins last year, who was at one point head of Barclays. And the title of the debate was, Are the banks responsible for the funding gap? And his debate, well, I say debate, he stood up and said some words and sat down and then got one of his members of staff to debate with me instead. But his view was there isn't a funding gap. And yet, from our perspective, we genuinely think that in various phases at different stages, there is a problem with businesses trying to get access to finance. And in an economy so dependent on SMEs for growth, that seems absurd. So today, we specifically want, in this short panel, to talk about the challenges and the opportunities for companies who may want to look to fintech and alternative funding as a source for their money, and why should they bother. So, Richard, surely these businesses are businesses, they know about finance already, so it shouldn't be a problem that they can raise some money.
Not at all, and I think one of the key issues is that there's a sort of an expectation on all entrepreneurs that they've actually got the tools to do not only the day job, but also the fundraise as well. And one of the things that we find the whole time is that the smartest of entrepreneurs just don't have the tools available to them, the people available to them, in what can be a very non-transparent and very opaque kind of world. And actually, it's not that difficult if they can find the right, neutral, friendly source of advice at the right price.
And is it more of a problem if they're trying to find debt or if they're trying to find equity?
I think it's across the board, actually. And I think for many, obviously, early stage entrepreneurs, there are some services, obviously, that do provide debt at a fairly early stage. But principally, this is an equity issue. And what that gets you into is term sheets, this vast morass of different sorts of potential marketplaces, some of whom are represented here on the stage, for different types of equity fundraise, angels, crowd funds, early stage VCs, angel syndicates, angel networks. Where do I start? And it is a massive issue, not just at that very first fundraise stage, but as you go up the different levels as well.
Let's start at the first phase, though, because we've got something here called the Seed Enterprise Investment Scheme, very quickly. I mean, the envy of the world. People who I meet day to day still don't even know that that's there. Can you explain in 30 seconds how it works?
Well, just 15 seconds. A CFO friend of mine, who's actually ultimately an investor in our business, CFO, who holds a quite significant role, asked me, what is SEIS? Quite extraordinary. SEIS, effectively, is a government-run scheme whereby you receive back at the point of your investment 50% through the income tax that you pay of the amount that you invest. EIS for slightly later stage companies, 30%. There are additional benefits should the company that you invest in not survive and go bust. You get an additional amount of your money back. There are limits on an annual basis. Different sorts of companies, depending upon how mature they are, qualify for SEIS. They're the very young companies. Slightly more mature companies qualify for EIS.
It's super Googleable in case anybody hasn't heard of it. So if I'm putting £10,000, Chris, through your platform into a startup, that means I put 10,000 in, I get 3,000 back. So effectively, I feel like I've invested 7,000. Is that still very much the profile for you guys? Is that the stage of company you are focused on helping to fundraise?
Absolutely, yeah. I mean, 90% of the raises are SEIS or EIS eligible on our platform. However, we are expanding to, we've got an office in Amsterdam and Berlin now, so we are trying to get more European companies on board where that relief wouldn't be the case. But yeah, the majority of investors we're reaching out to are people who are doing this on the side of their jobs in the city. They've got a high income, they want to be involved in startups, and there's a great way to kind of offset that risk slightly.
And what is the most common misconception that businesses have if they actually do come and talk to you about the whole process of raising money this way?
I think they think it's easy. Equity crowdfunding is not an easy route to finance. It does take a lot of hustle. Also, it is a public way of raising, so you need to be willing to put yourself out there, and reach out to a wide audience. This is as much a marketing and PR opportunity as it is raising money. So if you are just doing this for the cash, please don't come to us, because you want to be making a bit of noise about this.
Do you think they are right to ever be nervous about the degree of information they put out in the public domain?
Absolutely. I'm working with a deal that's just gone live called Plum, which is an artificial intelligent chatbot for saving money, and he was very skeptical around giving away his user numbers, which is completely fair enough. It's a very competitive landscape, so you basically put on the campaign the information you're willing to disclose to the public, your competitors, whoever, anything on the platform. We request evidence for, so it's fair, clear, and not misleading. However, you do have an investment deck that can be request only, so that doesn't have to be publicly available to everyone, and you can basically vet whoever you send that out to. So that's a way of keeping it a little bit more private, some information.
I raised some money with you guys 2 winters ago, and I don't have any O-levels because I'm 47 and I couldn't find my O-level certificates. So apparently I'm extremely underqualified from that point of view. But between you guys, even just between Seeders and Crowdcube, you're already some 20% of the equity funding market. So not quite this fad that's going to go away again. How does this fit in with maybe angel investing, which would have been what people were a bit more used to before?
Yeah, so in terms of where we fit with angel investing, I think what's kind of happened is there's been a maturity from when companies would kind of go around angel syndicates and meet in dark rooms with kind of big boards full of relatively old men. What this has done is essentially opened it up to a whole range of investors. So it's still including angel investment, and I think what we've seen is actually that the angel investors that would before have been kind of closed off and hard to reach are now on a platform. So your company is put in front of them without having to do that.
And we were talking, Chris, earlier about maybe not just about raising money, but other benefits. Do you have any stories or examples of companies where fundraising in this way has had other rewards rather than just getting the cash in?
Yeah, absolutely. So I think on the kind of larger end, so where we're funding companies like Monzo, for them, raising kind of 2.5 million as part of a 22.5 million round, they could have topped that up from VC money. For Monzo, it was very much about getting out to new customers, but also kind of supercharging their existing customers. So kind of bringing on their customers into the business. You can see really good retention from that.
Interesting coming on just after the IPO conversation and a lot of interest in equity crowdfunders in the UK, a lot of little financial stakes going on, which you won't talk about in too much detail. But do you think with the secondary market now coming online, are you going to put the P back in IPO? Is this going to be the new form of public offering for smaller businesses?
Yeah, so I think the secondary market is an opportunity for investors to get out before the business has actually exited, when it's still private, and through our nominee structure, which makes it very easy to basically buy and sell shares between other investors, and I think it's basically getting those investors on board who are a little bit more risk adverse, who potentially wouldn't want to have their investment in that company for 7 to 10 years. And it's now providing a liquidity option a little bit sooner than that. So I think this is a great way of bringing more liquidity into the equity crowdfunding market.
Is that a common mistake, Richard, that companies don't think about the total lifetime of money that they're going to need? They just think about the first bit?
Well, I think naturally, yes, because most early stage entrepreneurs are thinking about the cash I need in the next 9, 12, 15 months in order to survive and build my business model. So yes, inevitably that is the case. I think it's also an issue from the investor side as well. And I'm slightly nervous, I have to say, about any initiative which gives the impression that there is actually a real liquidity event for what has to be patient capital. Let's make no bones about it. Early stage equity is patient money. You put your money in and it's going to stay there unless something quite extraordinary happens, which is 1 in 10, 1 in 20, 1 in 25 chances. So I think that's an absolute key thing. And I think one of the issues about this marketplace in general is people focus too much on the success stories. And it's this whole silent evidence concept. There are many non-success stories, and that has to be taken into account in terms of each individual's investing experience.
Okay, so assuming we can get maybe some CDIS or EIS will get off the ground, one of the areas where we see clear evidence of a finance gap, particularly with the banks, Colin, is around sort of shorter term money, which is actually fundamental to being able to close a deal or get something done. What kind of finance are you guys doing, and where do you think the pain point is?
I mean, that's exactly the sector of the market that we're in. We're offering debt focused on very small businesses with a facility that's aimed to help them grow and manage cash flow gaps. Our product is a flexible line of credit that small businesses can dip in and out of. But along the lines of your questioning on the equity side, I think the reason that we exist is that the traditional routes that small business would have gone down, their bank, an overdraft, a small loan, have, particularly since the credit crunch, become more and more inaccessible to very small businesses. And I think the real change that we are really driving forward is using technology and data to make it faster, simpler and fairer for small businesses to get access to credit. That's our mission that we're on.
And as a working mum, I do my admin between the hours of 10 o'clock at night and about 3 o'clock in the morning. So, I mean, do you find that it's changing behaviours? I mean, are you getting feedback that suggests that people actually really respond to the online process and will stay where you are? Or do you think there's a risk that interest rates will change and people will disappear off elsewhere?
Very much so, and this isn't something that you need to take from me. I mean, if you go onto websites like Trustpilot, where we've got 1,300 reviews, a lot of the messages are about the speed and flexibility that it's given a small business. Our typical customer has less than 10 employees, turnover of less than £500,000, although we do serve some larger companies as well. These are not businesses that have got like a full-time finance director or someone with expertise in doing fundraising. So they need the flexibility to be able to go online, fill out simple forms. Our sign-up process takes a couple of minutes, and we find ways to make it easier for people to apply by linking other online accounts.
And what kind of decision turnaround can you give them?
So many businesses will go through our automated instant decision route, depending on how much they want to borrow. So that is literally filling out the form on the website for a couple of minutes, and timer will wear away for 15, 20 seconds, and they'll get an actual decision, not a decision in principle. So we're already operating automated decisions.
So Richard, going back to you, I mean, that anticipation, so how close you are to cash flow and recognising in advance when you might need the money, I mean, this speed to access must be quite important, because if you're a small manager and you leave it too late.
Yes, it is, and I think again it's this expectation management point, which I was kind of alluding to before, which is from the company perspective, it is understanding really where your money is most likely to come from. Is debt an option? Am I actually looking at going around friends and family at this stage because I don't have a mature enough business? What within the whole marketplace for different forms of funding is most appropriate for me? And these are pretty basic questions, but there are questions that don't get answered all that frequently particularly well.
So Colin, who do you work for? Do you work for the company borrowing the money, or do you work for the entity that's lending it?
Obviously I'm employed by the entity that's lending the money. So technically, I personally work for the company that's lending the money. But as a company, we are very customer service driven and are very focused on enabling our customers to grow through accessing credit. We always describe credit as the fuel that helps them grow their business.
Okay, but who pays the company money? Where does your fee come from?
We're a direct lender, so
you get the return on the investment.
Yeah,
from that
absolutely.
point of view.
Yeah.
Yeah. So I mean, certainly from my own perspective, I've got a two-sided network, and I need to get a good return for the investor and a low cost of finance for the borrower. And your model's rather different, Richard. You're pretty blunt.
Absolutely blunt. And short rant.
Already
Short
had
rant.
we've already had the small brands, and I can talk louder than you.
No, it's not.
I can sing, I'll always be louder. So you're paid by the company that's raising the money. Does that put you in a stronger position?
It puts us in a very clear position. And I think that one of the issues is that companies don't always know what they're getting from platforms that purport occasionally to be doing something for companies when in fact they've got an investor client base. Okay,
so Chris, you've got a two-sided network. So how do the fees work for you guys?
Yeah, so we take a 6% fee from the business for raising. You only get charged if you successfully hit your target and receive the funds. There's no listing fee. And then on the other side of the marketplace, there's no fee for investing. However, if there is a profitable exit in the business that you're in, then we receive a 7.5% fee from the investor profits.
So that must require you to stay close to the business after the fundraise.
Absolutely, yeah. And our whole model is that this isn't just a transaction, just doing a deal. We are with this company for lifetime, and we are making the decisions on behalf of investors, and we are there to protect the investors for however long it takes to make the exit. So we're helping them, make the right decision, and we are, we want to make it as easy as possible for the entrepreneur side, so that they can make a decision very quickly because we vote on behalf of them. They don't have to go to all the underlying investors, but then from the investor side, we are there to make a decision to help protect them.
So assuming that a company has done some kind of CDIS or EAS investment or something of that nature, the chances are there are future rounds to come. What's your experience of working with then the larger end of the VCs? I mean, do they all just go, filthy crowdfunders, I'm not touching it?
So I think that was something that definitely happened at the beginning when we were this kind of new, exciting, disruptive thing that not many companies had done. There was definitely a sense of, ooh, don't like this. But as we've grown in the last 6 years, we've now done 30 plus venture-backed deals. So that's co-funds with venture capital funds. So it's very much becoming the norm. As you said, we've covered 20% of the equity market. So turning their nose up at we hear a lot people saying things like, oh, if you've got a messy cap table, a venture capital fund won't look at you. But we ourselves have a messy cap table with thousands of investors, and we have investment from Bolton Capital and Draper and others.
I'm sure some of them are in the room. And Draper are one of the better ones, I would have thought, in terms of doing that stuff. But if I'm the company, if I'm the entrepreneur, and I'm trying to raise my next bit of money, and I'm really going for growth, how does that work? Can you help me with that? Do you do anything for me? Or am I just cast out? Or do I have to go back to Richard? I think I have to go back to Richard. There's only one solution, it's Richard.
So we're very much developing our own kind of growth services partnerships in order to help companies with this more. So this is with companies like Grant Thornton and kind of other additional services. Just announced a new partnership with WeWork, which is really exciting as well. So we're definitely kind of trying to develop that. It's not something we tie companies into. For us, it's very much, we want to be the platform that they use and kind of come back to because they've had a great experience and because we can help them additionally rather than kind of tying them in.
So let's be specific about that. So what can you do to help that entrepreneur? Particularly, if we're talking about now into the $500,000s and millions, I mean, what can you offer? What are their challenges? And why do you think this is a solution which betters what was there before?
Yeah, so in terms of, we are a fundraising platform, so we are a kind of marketplace for finance. So as the company's trying to grow, then what we can provide is kind of access to capital and access to new customers and investors. So where we sit is pretty much that. It's giving them brand exposure to our kind of 400,000 member base of people. Kind of early adopter technology, it's a very valuable kind of demographic.
But it's not the case that, I was like, oh, well, I'll just listen, they'll put me on the homepage and then I can be in those ads in the tube. I mean, you can't do that for everyone. Do they have to hustle to get your time and attention? How do you get to the top of the Crowdcube pile? If you say algorithm, I'm going to take your mic away.
Algorithm. So we do a lot to support our companies, and we've got around kind of 20 to 30 companies on the site at any one time. So it's very much a kind of consultative effort to help each individual company. Every campaign is completely tailored to what the company wants to achieve. For some of them, it's mass customer acquisition, so we'll work with them on that. For other companies, it's literally just looking at new markets and potentially getting a kind of one brand partner. So we'll kind of target things around that as well.
So, the equity stuff is always kind of the jazzy, fun, super high risk, but super potentially high return side of things. But, the vast majority of the market, something like 97% of the 10 billion raised has been in debt. So just going back to you, where do you see this evolving? Are there other holes where you really think, God, that's a space where small businesses aren't getting the help they need and we might move into it?
Certainly, we've been focused on one particular product till now, but fundamentally what we're doing is improving the experience for a small business in applying for credit and being assessed. So there is definitely room to offer them a wider range of products. At the moment, iWalker offers an unsecured flexible line of credit, and we're trialing a 3-year term loan. But there isn't any reason, and there's certainly demand from small businesses across a whole range of products. Some
do you
secured,
feel
some
you have
not.
a responsibility to do some education as you go?
When you say education,
To
as
help
in make small businesses more aware of all the different options? Absolutely, and we work very closely with aggregator platforms like the government mandated platforms like Funding Options, Funding Exchange, Business Finance Compared to really help them educate small businesses about the whole range of options to them, because our product isn't right for everyone.
You're referring to the platform, so there was a requirement that came in that if banks did say no, they had to refer the people they'd rejected to a small number. I think it's now the fourth platform's just coming online in a timely way so that the alternative lenders could get to them. I mean, one of the criticisms that has been levied of the industry is it's not very easy for borrowers to kind of compare and contrast the different sources of funding. I mean, is there anything that anyone feels they do to make it easier for people to know how to choose a platform?
I mean, there is a fundamental problem there in that you've got to compare apples with apples. And, you know, there are so many different products and different aspects about pricing that make it difficult to compare. So I don't think it's a kind of, somehow like a, malicious thing that it's being made difficult. I think it is fundamentally difficult. And, if you hear the likes of funding options or funding exchange talking about their offering, they're talking about more like a matchmaking service rather than a price or product comparison service, which is kind of subtly but conceptually quite different.
I mean, there are a number of options out there, Richard. I guess that's a good thing and a bad thing. Going to absolute very, very basics, I mean, what do people just not understand? Do you ever see people who come and talk to you like you're not even ready to talk to me? Let's start at the very beginning. I mean, would you ever do modules about education? I mean, I remember moving from energy into finance about 6 years ago and taking a day off to work out what a bond was. Yeah, and then after a day, I went, it's a bloody loan.
So yes, there are obviously people like that. Absolutely, there are. And do your best to help them. And what are you going to do to help them? You're going to not take a fee off them, okay? Because that's not right, and they don't have any money anyway because they're trying to raise some. And you're going to point them towards resource, which is helpful, and you're going to try and convince them that there is people around that can actually be supportive of them wherever they happen to be. So our mantra typically is to say, you are where you are in the process, let's find the right marketplace or resource or advisor that we know and trust to help you get through it.
I've just been doing some work on the Business Finance Guide, which is going into its third year, and actually really quite sensibly helpful, and they're taking it from a paper guide into a website where you can kind of follow the journey and answer the questions, see where you're at. So anybody who's in fundraising mode, it genuinely is worthwhile, and it's free, which is always nice. Where else would you point people in terms of trying to get educated and read up?
Well, that has been, death spiral into PDF. That has been the world, and everywhere where you think you might be able to go, which might be public bodies, regional bodies, and so forth, has been really difficult. I mean, in London, the great news is there's this amazing amount of resource, whether it's through Tech City, Tech London Advocates, and so on and so forth. It's a whole array of bodies, the meetups, the Silicon Drinkabout. There's a whole array of different places where you can go to hook up with people and meet people, and it's a highly cohesive and supportive community, actually. One of the problems that we see, actually, it doesn't work outside London. So it's great to be here, it's fantastic, and it's comfortable to be sitting in a place like this, having this sort of a conversation. These conversations happen much less in Liverpool.
Megan?
I think one quick and practical tip, I went into finance after university having studied an arts degree, and the one thing that helped me the most was actually Investopedia. That is a really good quick way to get some kind of, to look and learn about terms and understand kind of valuation methodologies and things like that.
And it is a much more transparent industry than traditional investment. So, I mean, I have to admit that I've definitely, before I've raised money, had a scoot round both of your websites and got some comps in terms of the valuation of a company. Do you think the stuff that we can all learn from each other just by using the platforms?
Yeah, absolutely. I mean, if I was a startup and you're looking to raise finance, obviously don't just go to one place and just chat to them and say, yeah, let's go for it. I'd say when someone talks to me about raising on Seeders, I'm always open to give them the other options in terms of, is it Kickstarter? Are you too early stage for us? Is it something where you want to go? Is it debt based? Is it a loan? Because we only make a fee if you are successful. So I'm not just going to push any business onto the platform. So we are also there to help support you and give you other options because we know the space very well. But before I went into Seeders, I was absolutely clueless. Like went on Dragon's Den and got offered investment on there, and got this term sheet from Duncan Valentine, and it was the biggest load of crap I've ever seen in my life. Like, it was just a joke. And I had no idea about the world of investment. And then obviously came across Seeders and other platforms like Crowdcube, and it is an amazing, the wide range of options out there. There's so many options. You just really have to get to events, open your eyes, and get out there and check it out.
I mean, are the days where you used to pay some bloke $5,000 a month to go and find money for you nearly over, Richard? Please say yes.
I've just got to say, you've broken the rule. You've mentioned Dragon's Den in a serious discussion about finance.
It's a good TV show.
Anyway, no, those days aren't over. And actually, it's one of the things that really makes me cross, that there are people out there, frankly, who don't have great skills, who don't have great networks, who don't have fantastic experience in terms of raising money, but they're still wanting to take upfront fees off people or retainer fees off people to help them raise money. And actually, it's not just with individuals. It goes across the board, and it's one of the reasons, going back to what Chris was saying about where you need to be really, really careful about where you go for funding. And we've seen cases of companies who've gone into fundraising term sheets, and they've looked at their term sheets, and they've realized that potentially up to 27% of the fundraise is going to get taken in fees over the course of 3 years. I mean, there's some quite extraordinary behavior out there. And I kind of understand on one level, because at the early stage, yes, there are costs involved, but really that doesn't work. There got to be better ways than that. And yeah, there are. And it's just a question of pointing people in the right direction so they can find them.
So if you, Colin, are benefiting hopefully from the funding exchange, funding options, the platform that are referring borrowers where the banks can't help, would you return the favour as well? Do you get applications which fall outside your remit and you would go, you need equity, and send them to Megan?
Generally, our website is so clear about what we do offer and what we don't offer. We don't get a huge number of people coming to us for things other than, a flexible line of credit up to £100,000. So that's not a huge thing for us. But I would sort of reiterate what you've said, that I don't want to bite the hand that feeds us. We get a lot of referrals from brokers. And it's a very mixed world. There are people that deserve making something out of the service that they're giving a small business. They're genuinely working hard, weighing up different options and finding the best deal, negotiating with us as a lender to get a better deal. And they deserve some value for their service. But there are many who are not really adding much value in the process. And,
do we have any brokers in the room? No? Nobody wants to have a little retaliatory mark to that. Great, we're very nearly out of time, but are there any questions from the floor? The lady here with the hand up. I have total gender bias.
Hi, I work for an SME finance company as well, and one of the things that we find very difficult is that when we talk to potential clients, they are just very unwilling to try something different from banking. Even if we can provide something that's more flexible, provide other things, they're just very resistant to change. And do you guys have any views on how we as an industry can change that and try and get people to be a bit more open to alternative lending?
I think it's a trust issue, and I think many people have been burnt so many times by some of that not particularly scrupulous behaviour that I was referring to before. I think it's down to you as a firm and to the industry in general to get transparency and clarity of exactly what the proposition is, who you're working for, who you're charging them for what, and on that basis, level playing field. If you've got a great product, no issue whatever. And obviously, as far as the traditional banks are concerned, we know that they can't operate in this space. We know there's this funding gap, massive issue, which is that the traditional banks have nothing at all to offer SMEs. They have no product. So it's the people around here that have got the product. So it's up to us to sing loudly and to get brands built on the basis of trust.
Colin, you've got 60 seconds to sell iWalker. Go on.
No, I was just going to say it's more than that. You've actually got some traditional lenders like banks actively collaborating with alternatives. So I think to address this issue of trust, if you can show your credibility about who you're working with and who is referring to you and who you're partnering with, that helps create that trust. Certainly from our experience, it helps a huge amount to be able to say Royal Bank of Scotland and NatWest are referring their customers to us. It means a lot to customers that haven't come across us before.
One last question. There's a bloke at the front.
I have a question about debt instruments and crowdfunding. One of the points of criticism that you get a lot is that it's a lender of last resort and that it hasn't yet been through the cycles. How do you react to that commentary?
So there's a couple of points. I mean, I think it's true of any young industry. You know, you want some longevity, and we only have about 4 significant platforms that were here before 2008. It kind of relates also to the question about interest rates, and will it be the case that interest rates go up and therefore the market dies? I'm not a huge believer that the banks are going to pass that spread on to the savers anyway. And if the rates go up, the cost of borrowing goes up at the same time. There's one study that PwC did which talked about how sustainable the advantages of the industry when that happens. And I think it's just the innovators have got this huge advantage around speed and the fact that we don't have the legacy systems in place and the footprint behind it. So I think it's been a really helpful 10 years. I don't think we would have the industry we do now if it hadn't been for 2008 and the banking crisis, for the encouragement that the government gave us to get more competition and diversity into the market. But I would argue that at 10 billion, and with our own ISA, we're getting sufficiently mainstream that it's here to stay, and that we should be able to ride that out. And what I'm particularly encouraged by is a couple of the big lenders who are not taking on any more lenders through the platform because they just can't get the scale and the quality of deal flow that they get. So I think that's quite an impressive little signal that they're not just going to grow at whatever speed they have to get there. They will throttle the money they bring on the basis of when they can actually deploy it at the same time. So yeah, it's still early days, but yeah. Any more? Are we allowed one more? No, not allowed one more. May I please thank my panel, Richard, Chris, Colin and Megan. Very well done. Thanks so much, guys.